Welcome to the Deep Dive. We're the place where we take those complex reports, all that market noise, and just boil it down to the insights you actually need. And today, wow, we are diving into a true global giant, a name everyone knows, Nike. They've just released some pretty significant financial results, and honestly, they're already causing ripples. We're here to unpack it all for you. So, our mission today, a proper deep dive into Nike's fiscal 2025 results as the fourth quarter and the full year. We're looking at how they're doing, what their plans are moving forward, and maybe most importantly, what different experts are saying about whether the stock's a good value right now. We're using their official investor info, a detailed valuation report, and yeah, the latest market news. By the end of this, you should have a really solid handle on Nike's financial picture, the big strategic changes they're making, and, why there's such debate about its stock price. Undervalued. Overvalued. We want you to have the clarity to decide. Okay, let's get into it. So today, June 26th, 2025, that's the day Nike dropped these results. And look, it's been rough for the stock, hasn't it? It's lost about a fifth of its value just this year and something like 35% over the last 12 months. That's quite a slide.
Yeah, it really has. And, what's interesting is that a lot of analysts kind of saw this coming, or at least expected a dip in sales and earnings. Nike themselves had hinted at challenges, things like tariffs, restructuring costs they knew were coming. Their CEO, Elliott Hill, put it pretty directly. He said the results are, and I'm quoting here, in line with expectations, they are not where we want them to be. That phrase, not where we want them to be, that's key. It signals they know things need to change, and they're focusing on executing what they're calling their win-now actions, turning the page, basically.
Okay, in line with expectations, but not where we want them to be. That definitely sounds like they're managing expectations, but also acknowledging problems. So these win-now actions, what are they actually doing? What's the plan?
Right, that's the core of it. Their win-now strategy is built around this idea of a sport offense. Think of it as four main pillars they're pushing hard on right now. First up is product excellence. They're really trying to prioritize the big categories: running, basketball, football, training, sportswear. It sounds like they want to shift away from just, basic classic styles and really focus on innovation and performance again. Less reliance on the stuff that's maybe become a bit commoditized.
Okay, sharpen the product focus. Makes sense. What's next?
Second is geographic focus. They're putting a lot of energy into their direct-to-consumer, or DTC, business, but specifically in 5 key cities: New York, LA, London, Beijing, and Shanghai. And the reason is pretty compelling. Those 5 cities alone apparently drive 60% of their revenue. So concentrating efforts there is, well, strategic.
60% from just 5 cities. Wow. Okay. Pillar 3.
Third is cost discipline. This one's pretty ambitious. They're aiming to slash $1 billion in annual costs by 2026.
$1 billion.
$1 billion.
Oh.
Yeah, it's a huge number. They're talking about things like outsourcing some technology, just making operations more efficient across the board. It's a major cost-cutting drive.
And the last one. You mentioned innovation earlier.
Exactly. Pillar 4 is all about innovation. They're highlighting new products like Pegasus 41 running shoe and this internal program called Speed Lane. The whole idea behind Speed Lane is to get new products out faster. They actually want to double the growth from innovation by the end of 2025. So faster, more impactful product drops.
Right, that's quite the strategic overhaul: product, location, costs, innovation. So the big question then, did any of this show up in the numbers they just reported for Q4 and the full year ending May 31st? Or is this all still just plans on paper?
Well, these numbers definitely tell a story, and honestly, they mostly underscore why that win-now strategy is so urgent. Let's break down the fourth quarter first. Total revenues were $11.1 billion. That's down 12% compared to last year. And even if you strip out currency effects, it was still down 11%. That's a pretty significant drop.
A double-digit decline. Ouch. What about their own channels, like their website and stores? That direct business was supposed to be their growth engine, wasn't it?
It was, and that's where things look particularly tough. Nike direct revenue overall was down 14%, but the real shocker was Nike brand digital, so their online sales. That plunged 26%. 26%.
Whoa.
Yeah. There was a tiny bright spot with a 2% increase in their physical Nike stores, but it didn't come close to offsetting that digital drop. At wholesale, selling through other retailers, that was down 9% too.
Okay, so weakness pretty much everywhere. And Converse, how did that part of the business do?
Converse had a really rough quarter too.
Mm.
Revenue was $357 million, which is down 26%. And that decline was apparently across all regions, so it wasn't just one bad market.
Okay, sales down across the board. How did that flow through to their actual profits? What happened with gross margin?
Yeah, the gross margin took a big hit. It fell by 440 basis points. That's 4.4 percentage points down to 40.3%.
And why such a big drop?
It was mainly down to two things. Higher discounts, they clearly had to mark stuff down to sell it, and changes in their channel mix. Basically, a bigger slice of sales came through wholesale partners, which carry lower margins than their own direct sales.
Right, discounts eat into profit. So the bottom line then, net income, earnings per share, that must have been hit hard.
Hit very hard. Net income for the quarter was just $12.2 billion. That's down an incredible 86% from the same quarter last year.
86%.
Yeah. And diluted earnings per share, the EPS number everyone watches, that fell to $1.14, also down 86%. It shows just how severely those sales declines and margin pressures crunch their profitability. And just to add another layer, their effective tax rate also jumped up quite a bit, from about 13% to over 33%, mostly due to some effects from stock-based compensation and one-off items hitting pre-tax income.
Those are some really stark quarterly numbers. Was the full year picture any better, or did it follow the same trend?
The full year definitely reflected those same pressures, though maybe not quite as drastic as Q4 in percentage terms. Full year revenue was $46.3 billion, down 10% reported. Gross margin for the year was down 190 basis points, so 1.9 percentage points to 42.7%, again, driven by discounts, channel mix, and also some higher charges for getting rid of old inventory. There was some offset from lower product costs, but not enough. And for the full year, net income landed at $3.2 billion, down 44%. Diluted EPS was $2.16, which is down 42%. So, yeah, tough year overall.
Okay. And how does the company look financially overall? Like their balance sheet, are they piling up inventory, cash levels?
Good question. Inventory as of May 31st was $7.5 billion. Interestingly, that's basically flat compared to last year. So while sales are down, they haven't ended up with a massive pile of unsold stuff, which is, well, something positive. Management did say it's still a work in progress, though. Cash and short-term investments are at $9.2 billion. That's down about $2.4 billion from the previous year. But that decreased because they used cash for things like buying back shares, paying dividends, paying off some debt, and capital spending. So it's not necessarily a bad sign, more a reflection of where they're allocating capital.
Right. You mentioned dividends and share buybacks. Even with these tough results, Nike's known for returning cash to shareholders, isn't it?
Absolutely. That's one thing they've been very consistent about. This actually marks their 23rd year in a row of increasing their dividend payout. Quite a streak. In Q4 alone, they returned about $0.8 billion to shareholders. Most of that was dividends, $591 million, up 6%, and the rest, $202 million, was share repurchases. Over the full fiscal year, the total return to shareholders was around $5.3 billion. So, yeah, even in a difficult period, they're prioritizing those returns.
Okay, so that brings us to the really tricky part. We've seen the challenging numbers. We've heard about the turnaround strategy. What does this all mean for Nike as an investment now? The stock's around, what, $61, $62? Is it cheap? Is it expensive? It seems like nobody agrees. If you look at the standard price to earnings, the PE ratio, the trailing PE, based on past earnings, is hovering around 20x. That's actually a bit higher than the industry average of like 15x. So maybe not super cheap based on what they just earned. But then you look at the forward PE based on what analysts expect them to earn over the next year, and that jumps up to almost 31x. That's way above the industry average of 24x and the S&P 500 average near 22x. That seems high. It suggests the market is already pricing in a pretty significant recovery despite the stock price falling.
That's a really crucial point. That high forward PE is where a lot of the debate comes in. It signals that expectations for a turnaround are definitely baked into the price, even after the recent drop.
Okay, so let's get specific. What are the different fair value estimates saying? Because they seem to be all over the map.
Yeah, completely. On the one hand, you've got arguments that Nike's actually undervalued right now, maybe even cheap. Morningstar gives it a 5-star price, their fair value estimate of $78.40. That suggests, decent upside from here. And Simply Wallerstein is even more bullish. Their calculation puts the fair value at nearly $113. That implies the stock is like 47% undervalued. These views probably focus on the long-term brand power and the potential success of the turnaround plan.
Right. But then you have the other side of the coin arguments that Nike is still overvalued even at $60-something. Alpha spread using one valuation model based on intrinsic value comes up with about $52.68. That suggests it's maybe 14% overvalued. And using a different method, a discounted cash flow or DCF model, alpha spread gets an even lower value, around $47.74. That would imply it's overvalued by more like 22%. These models are likely weighing the current weak earnings and the execution risks more heavily.
So fair value estimates ranging from under $50 to over $110. That's a massive range. It really is. And it perfectly captures the split opinion among analysts. You still have many with buy ratings. The average long-term price target seems to be around 71.1, which suggests maybe 16% upside. But then you have others like Morgan Stanley who've recently cut their targets. They're pointing to those macroeconomic headwinds, tariff uncertainty, and basically saying this recovery might take longer than people think. So you can see the tension. Do you bet on the iconic brand and management's ability to pull off this win-now strategy, leading to that higher valuation? Or do you focus on the current weak numbers and the risks ahead, suggesting the stock is still too expensive? There's just no easy answer right now.
It really paints a picture of a company at a crossroads, doesn't it? Facing significant challenges, but also actively trying to pivot. So what's the takeaway for the road ahead?
I think the main takeaway is that Nike is being very proactive. They're not sitting still. They know they're not performing where they need to be. And they have this clear, multi-pronged strategy, product, geography, costs, innovation that they're implementing. We saw some small positive signs like inventory being flat year over year instead of ballooning, which is good. But management themselves admit it's a work in progress. And it's interesting to see them strategically increasing prices on some higher-end footwear, specifically items over $100, partly to offset those tariff impacts. It shows they're using multiple levers to try and navigate this.
And beyond just the financials and strategy, are there other things investors should keep an eye on?
Yeah, definitely. Nike always emphasizes its broader commitments, too. They have these 2025 goals around sustainability and diversity, like hitting 50% female representation in their corporate workforce, using much less carbon and new materials like their Nike Forward platform. Those things matter for brand perception and, increasingly, to investors and consumers. It's part of the long-term picture. And they also just nominated a new person, Jürgen Vignudstorp, to their board. That could signal, fresh perspectives or shifts in governance down the line. Ultimately, the big question remains, how fast can these strategic changes actually start moving the needle on the financial results? And can they do it effectively while navigating this tricky global economy? That's what everyone's watching.
Okay, so let's recap. We've dug into Nike's really challenging fiscal 2025 results, particularly that tough Q4. We've laid out their big win now strategy aimed at turning things around. And we've explored just how divided opinions are on whether the stock is a bargain or still too pricey. So here's something to think about. You've got Nike pushing hard on cutting costs and trying to speed up innovation. At the same time, you have shoppers potentially pulling back on spending, and this huge disagreement among experts about the company's true value. How do you see those pieces fitting together for such an iconic brand over the next few years? Where do you think Nike goes from here? Thanks so much for joining us on this deep dive into Nike. We really hope this gave you a clearer, more informed perspective on everything that's going on with the company right now.